Okay, Chapter 2, Analyzing Transactions. Make sure that you've read the chapter before you go through this presentation, at least these first two sections, all right? And then come back and, it'll make more sense to you. But there's a lot of material here, and if you haven't had any accounting before, it's all brand new stuff. So these are the learning objectives for this chapter. What we'll do in this presentation is, first of all, talk about the characteristics of an account and a chart of accounts, and then look at journalizing transactions using the double entry system. From here, we go to posting transactions to accounts, then preparing an unadjusted trial balance and seeing what that's used for, and then finally we'll end up with some horizontal analysis and analyzing a company's performance. So accounting systems designed to show the increases and decreases in the accounting equation, okay, in each accounting equation element as a separate record. And this record is called an account. So if you pictured the accounting equation and then say underneath the asset side, you would have a separate little equation for each separate account. Okay, and accounts go up and down. Here's the net solutions, their November transactions that we looked at before, and these are all of their transactions, all their entries, and you understand that we can't do this for a regular company that has, hundreds of thousands, if not millions. I'm sure Amazon has millions of transactions per day. So we can't do this. We need another way to keep track of things. But you can see the accounting equation though here too, and we had assets and then liabilities. We only had one liability here, but anything that ends with the word payable is a liability. And then all of these are owner's equity accounts. Okay, and there's our accounting equation. Now, these are T accounts. I use them all the time. I like them because they take confusing things and just make it clear. I can sort something out using T accounts. And what it has is a left and a right side, and this comes from the Latin debere credere. Not that that does you any good, but you want to think that debit just means left and credit means right, and that's it. Okay, there's nothing good about a credit. There's no qualitative judgment with these. So we've got a T account here with the account title would be like cash, and this is the debit side, and that's the credit side, and that's all it means. And here's a nice example of a cash account with several transactions. These, I think, came off they came off that Net Solutions transactions that we booked earlier, all those transactions we recorded. There's a deposit, and this, I think, was a sale for cash, and these were the bills that they paid. Okay, and then if I take my total debits and subtract my credits, I find that I've got a $5,900 balance in the account. So if this was cash, and if we received this cash and we paid this cash, that's how much cash I would have left over. Okay? So a group of accounts for a business entity is called a ledger. All right, it's an old word, but it's a specific word. It's called the general ledger. And a list of accounts in the ledger are called the chart of accounts. So every business has a chart of accounts. Now, we're going to look at some examples of some accounts here, and all I can say is just learn them. Just get to know the names so that you don't struggle over it or you don't have to try to figure out what it is. Just know what they are. And until you can just, like, if I asked you to tell me the assets, you could just rattle them off. Or give me some accounts payable. Or give me some expense accounts. You just need to say the names, okay? It's one thing you just need to know. And then after a while, you don't have to think about it, and it's already in your head. So some examples of assets would be cash, supplies, accounts receivable, and buildings. Okay, those would be assets. Liabilities would include accounts payable, notes payable, wages payable, interest payable. Anything with the word payable on the end is a liability account, and that would go on the balance sheet, right? Now, owner's equity is the residual interest. Remember, it's the owner's right to assets of the business after all the liabilities have been paid. So for proprietorship, owner's equity is represented by the balance in what we call a capital account. And a drawing account represents the amount of withdrawals made by the owner, and we do keep track of that. Revenues, increases in assets and owner's equity resulting from selling services or products. So it could be fees earned, commissions, revenue, rent revenue. Okay, it could also be sales. Using up of assets or consuming services as it results in expenses. So wage expense, rent expense, miscellaneous expense, supplies expense, insurance expense, salaries expense. Those are all expenses, and it ends with the word expense, so you know where it belongs, right? Okay, so revenue minus expenses would be net income. Now here's the chart of accounts for net solutions, and there are a few things to notice here that depending on the major classification of the account, like as let's say assets, all the assets, the first digit's a 1. For liabilities, the first digit is a 2. Okay, equity accounts begin with 3. Revenue 4, expenses 5. Most accounts within like big corporations are at least 6 digits long, and each digit in that account number tells you something about the account. Okay, and then we've got 1, 2, they skipped a few in here just in case you want to put another account that would fit in there, but they're sequential. So the account numbers are all unique, but they indicate which piece of the balance sheet or income statement the account belongs in. Okay, so now we get to the double entry system, and this was actually invented, I think it was in the 1400s by a monk in Italy, and his name was Luca Pacioli. Is that right? That's possible. So all businesses use what's called this system, and every business transaction has to be recorded in at least 2 accounts. It could be more, but when you think about the accounting equation, we never made an entry that only had 1 entry, right? We always had more than 1 account on for each entry that we had. And the other thing that makes this work is that the total debits that are recorded equal the total credits. Okay, so the double entry system has specific rules of debit and credit for recording transactions. And we will do so many of these that by the time you're done with this module, you'll know this and it won't be any problem. So these are the balance sheet accounts. And for a balance sheet account, we increase assets with a debit, increase liabilities and owner's equity with a credit. Okay? And if you increase something with a debit, then you would decrease it with a credit. Okay? And similarly, on the liability and equity side, we'll increase this with a credit. So to decrease it, we debit it. And this one is going to feel a little bit funny to you. The one that you'll get right away is increasing assets with the debit, like debit cash. Okay, that'll be all right. Here are the income statement accounts. And the way to think about this is that these move the way owner's equity moves. So revenue increases with the credit. Okay, and expenses increase with the debit, and they subtract from revenue. For the drawing account's kind of a sneaky account. It's considered a contra equity account because it holds the opposite balance of the account that it's associated with. So a drawing account is kind of connected to the capital account, and to increase it, we debit it, even though it's over on the capital side. But we're increasing a negative account. That's the way to look at it. And this is a chart that I like, that I use for keeping track of this. And you can think of the balance sheet and the income statement as one big T account. Okay? And everything on this side increases with the debit. So your assets and your expenses. And if it increases with the debit, then it decreases with the credit, right? Now on the credit side, your liabilities, equity, and revenue all increase with credits. Okay, and I put revenues on the same side as owner's equity because revenue increases owner's equity. Okay, now this helps some people, doesn't help every people, so you can decide what you want to do with it. So let's go through some transactions here. Okay. Oh yeah, normal balances are important. Like if you think that the increase, like you're not going to have negative cash, right? Or negative prepaid rent. It doesn't even make sense. You're not going to overpay your bills generally. So accounts have what we call normal balances. And the normal balance could either be a debit or a credit. But if you go back, let's go back. If we go back to this, all the assets, all of these accounts, assets and expenses normally have a debit balance. Okay? And the other little trick is that assets go up and down, especially cash, okay, the current assets. Expenses only go up. So you're just going to be debiting these. And then when we think on the credit side, liabilities will go up and down. We'll borrow money and then we'll pay it back. Or we'll take on an accounts payable and then we'll pay it back. So these go up and down. Revenue will just go up. So we're going to debit the expenses and we're going to credit revenue. Okay? I say that like you're going to answer me. I have to stop saying it. All right, here's another chart that you can see the normal balances. You can see the asset accounts normally have a debit balance. Liabilities and equity normally a credit balance. Revenue has a credit balance. Expenses have a debit balance. And the crazy drawing account, that'll have a debit balance also. Okay, so all of these things together should help you at least see what it's supposed to mean. So let's do some of these. Let's state for each account whether it has should have debit entries only, credit entries only, or both. Okay, and it's so handy because the answers are right down there. Amber saw the drawing account has debit entries and it has a normal debit balance. Accounts payable has both debit and credit, normal credit balance. Cash has both debit and credit, normal debit balance. Fees earned. Okay, this normally has a credit balance. All right. Supplies, if it just says supplies, then it's the asset. So that would have debits and credits. And the utilities expense is an expense. It would have a normal debit entry, and it would only have debits. Okay. So we enter transactions in journals. And here's a description of what we put in here. Let's take a look at it and go from there. Here's a journal, and it's called journalizing, okay, specifically. So here's a journal, and think of it as that it tells a story, and things are listed by transaction. So the date is first, then the accounts, and the debits go to the left, and the credits go to the right. All right, and then some kind of a description is in here. Then there's my debit and credit amount. And each transaction has to have two sides. So this is Chris Clark deposited $25,000 in a bank account. Cash increased by $25,000, debit cash, credit Chris Clark Capital. Okay, and here are different ways. This is just terminology. Like if you purchased on account, the word purchased on account, that would involve accounts payable and whatever asset you bought. Okay, if you paid cash, you either bought an asset or you paid some expenses. The credit would be to cash. Okay, take a look at this in your book. I'd like to get to do it. I don't want this to be too long, and it's already long. Let's do some more entries. Here's Net Solutions paid $20,000 for the purchase of land for building site. Debit land, increased land, credit cash, $20,000. They purchased supplies on account for $13.50. Debit supplies, credit accounts payable. And notice the format here. The debits to the left and the credits to the right. All right, my total debits equal my total credits. Now they receive cash of $7,500 from customers for services provided. So cash increases by $7,500, debit cash, credit revenue. Okay, debit cash, credit revenue. These are nice slides. So you've got the whole PowerPoint in there that you can look at without having to listen to this. They did a nice job on these. Now here they incurred the following expenses. Remember when we paid all those expenses? So we've got wage expense, rent expense, utilities expense, miscellaneous expense. These are all debits because they all increase expense, and then decrease cash. Decrease cash by $36.50. And this is called a compound journal entry because it's got more than just two accounts in it. Then they paid creditors on account $950. So here we're sometimes, like if you're confused and you're not sure about debiting that payable, what you can do is credit cash first. All right, do the part that you're sure of. So if you know cash is going down, then this has to be a debit, and you would debit the payable, and then when you think about it, it might make more sense. Then they purchased supplies of $13.50. Clark determined that the cost of supplies on hand was $5.50. So if they had $13.50 and there's $5.50 left, then they used up $800. That would be the expense. So debit supplies expense, credit the asset supplies. Okay, increase the expense, decrease the asset. Okay, we're almost there. Now we withdrew $2,000 for personal use. Debit, increase the drawing account, debit the drawing, credit cash. And this is a good example of where you might be confused. Now you know that cash went out, so for sure you could credit cash. This must be a debit. Okay, I think that's it. Here we are. So now we're going to do a journal entry for the purchase of a truck for $42,500, paying cash and the remainder on account. Let's do that here. All the answers right here, isn't it? They bought the truck. The truck is worth $42,500, so debit the truck. And we paid $8,500 in cash, credit cash. And then the remainder would be $34,000, and that would be in accounts payable. Okay, so I'll see you in the next presentation where we work a full page of just short transactions.